What if I told you that two of the most popular ways to invest, ETFs and mutual funds, might seem similar on the surface, but could lead you down very different financial paths? And the kicker? Choosing the right one could help you retire years earlier. Welcome back to the Money Mindset Hub, the podcast where smart money moves meet real-life clarity. I'm your host, Raul Sofa, and today we're diving deep into one of the biggest beginner questions in investing: ETFs versus mutual funds. Which one is best for you? Whether you're just starting your investment journey or finally ready to stop letting your savings sit idle, this episode will break down what these funds are, how they work, and which might fit best with your goals, lifestyle, and risk comfort. Grab your notebook or just listen closely, because by the end of this episode, you'll walk away with a clear direction on how to make your money work smarter. Let's start with a little story. A few years ago, my friend Emma, fresh out of university, first big job, newly armed with a paycheck, decided it was time to start investing like an adult. She had no clue where to begin. She Googled everything from best investments for beginners to how to get rich without trying, and two terms kept popping up: ETFs and mutual funds. But no matter how many videos or articles she read, the definitions blurred. Fees, taxes, automatic investing, NAV trading times. It felt like a foreign language. And like many, she froze. She parked her money in a savings account and waited. 2 years later, she finally took the leap. And what she discovered changed the way she thought about money. Today, we're going to unpack that same journey Emma went through, so you don't have to learn the hard way. Let's get the basics down first. ETFs stand for exchange-traded funds. They're like a basket of stocks or bonds you can buy on the stock exchange, just like buying a regular stock. You can invest in an ETF that tracks the S&P 500, tech companies, international markets, or even green energy. Mutual funds are also baskets of investments: stocks, bonds, or a mix. But instead of trading on an exchange, they're managed by professional fund managers. You buy them directly through an investment company or a brokerage. Key difference? ETFs trade like stocks throughout the day. Mutual funds trade only once per day at the closing price. Simple enough so far, right? But now let's get into what really separates the two. Let's talk about fees, the part many new investors overlook until it's too late. ETFs usually have lower expense ratios. That's the annual fee charged for managing the fund. Think 0.03% to 0.50% annually. Mutual funds, especially actively managed ones, often have higher fees, sometimes over 1–2%, and that difference adds up. If you invested $10,000 in an ETF charging 0.05% versus a mutual fund charging 1%, over 30 years, that's thousands of dollars lost to fees. Some mutual funds also charge sales loads, basically commissions. ETFs? Usually none. Actionable tip: always check the expense ratio and any sales load before buying into a fund. Here's something else to consider: how you buy and sell. ETFs trade all day like stocks. That means you can buy or sell whenever the market is open. Great for flexibility. Mutual funds only trade once a day, after the market closes. The price is set based on the value of the underlying assets at that moment. Why does this matter? Let's say a market crash happens midday. With ETFs, you could react quickly. With mutual funds, you'd have to wait until the day ends. But on the flip side, if you're a set-it-and-forget-it type of investor, this may not matter at all. Alright, let's talk accessibility. ETFs can be super beginner-friendly. Some cost less than $50 a share, and with fractional investing, you can start with even less. Mutual funds often require minimum investments, sometimes $500, $1,000, or even $3,000 just to get started. This can be a big barrier for young professionals or students just stepping into the investing world. Actionable tip: If you're starting with a small amount, ETFs may give you more flexibility without the pressure of hitting a minimum. Now let's talk strategy. ETFs are usually passively managed, meaning they just follow an index. No fancy fund manager making constant trades. That's why fees are low. Mutual funds can be actively managed where fund managers try to beat the market. But guess what? Most actively managed funds fail to outperform their benchmark over time. So you might be paying more for a strategy that doesn't necessarily perform better. Inside, passive ETFs can be great for long-term, low-cost growth, but some mutual funds do outperform, and some investors prefer that human touch. Ah yes, everyone's favorite topic, taxes. ETFs are usually more tax efficient. Why? Because of something called the in-kind redemption process. It helps ETFs avoid triggering capital gains taxes during internal trades. Mutual funds, on the other hand, may distribute capital gains to investors even if you didn't sell your shares. In other words, you might owe taxes on profits you didn't personally make. Actionable tip: if you're investing in a taxable brokerage account, ETFs can help keep your tax bill lower. Let's bring it all together. Choose ETFs if you want low fees. You're okay managing your own trades. You're starting with less money. You want more control and tax efficiency. Choose mutual funds if you prefer a hands-off approach. You want professional management. You're investing through a 401k or retirement plan where mutual funds are the default. Remember, there is no one-size-fits-all. The best investment for you is the one you'll stick with consistently. Let's go back to Emma. She started with ETFs, small automatic contributions to a total stock market index ETF. A year later, she added a bond ETF for balance. No stress, low fees, growth over time. That simple strategy, it worked. She's now built a 5-figure portfolio from small, consistent steps. And the truth is, you can too. Don't wait until you know everything. Start with one fund, $1, one decision. Because the earlier you start, the more time your money has to grow. And that, my friends, is the real secret of wealth. Thanks for tuning in to this episode of Money Mindset Hub. If you found this breakdown helpful, don't forget to like this video, subscribe to the channel, and turn on notifications so you never miss a new episode. Share this with a friend who's been wondering how to start investing. Drop a comment. Are you Team ETF or Team Mutual Fund? This is Raul Sofa reminding you, you don't need to be rich to start investing. You start investing so one day you don't have to worry about money at all. Until next time, invest smart, live free.